Every single day, hedge funds generate more than $1 million in profits. Not once a year, not once a quarter, every day. And while most people are focused on saving a few dollars or chasing the next trend, these institutions operate behind the scenes, quietly executing a system that produces wealth at scale. This video will break down exactly how that works. If you're someone who trades, invests, or simply wants to understand how the financial elite actually make their money, you're in the right place. Today's video isn't about speculation or hype. It's about systems, strategy, and the mindset that drives consistent, scalable returns. Because the reality is this: hedge funds aren't winning because they're lucky. They're winning because they're structured differently, mentally, technically, and financially. Once you understand how they're built, you can start thinking more like a fund, even if you're just starting out with a small account. Most traders and investors approach the markets emotionally. They react, they guess, they get attached to outcomes. But hedge funds don't operate like that. They don't treat trading as a gamble or a guessing game. They treat it like a business, with rules, with discipline, with risk controls. That's the shift we're going to unpack today. What this video covers: this breakdown is built around 3 key pillars. 1. The structure. How hedge funds are built to make money daily. We'll look at the business model behind hedge funds, how they're set up to earn even beyond just winning trades. 2. The mindset. Why fund managers think differently. This section covers the psychological edge. We'll explore how hedge funds avoid the common traps that most retail traders fall into. 3. The strategy stack. Tools and approaches used for consistent returns. Finally, we'll walk through how they make money in up, down, or sideways markets, and how they structure strategies to manage risk and compound growth. By the end of this video, you'll have a clear understanding of what separates hedge funds from the average trader, and how you can begin applying those principles at any level. Let's start with the foundation. 1. Hedge funds are businesses, not just trading accounts. Most traders operate like freelancers, solo, reactive, with inconsistent results. But hedge funds are structured like businesses. They have a process, a team, clear metrics, and defined systems to reduce randomness. They're built with one purpose: generate alpha, returns above the market, with as little risk as possible. That means they don't rely on luck. They don't chase every trend. They don't operate without a risk model. Every move is intentional, measured, and scalable. 2. Multiple revenue streams, not just from trading wins. Here's where it gets interesting. Hedge funds don't just make money when they win trades. They also generate income from management fees and performance fees. Let's break it down. Management fee, typically 2%. This is what clients pay just to have their money managed. Whether the fund wins or loses that month, they still earn this fee. Performance fee, typically 20%. This is a cut of the profits. If the fund performs well, they take a portion of the gains, often 20% of all returns above a certain threshold. This setup creates a stable cash flow model. Even if trades don't hit every single day, the fund still earns. Compare that to most retail traders, who only earn if a single trade works out. 3. Capital leverage, using other people's money. Another key difference. Hedge funds manage large amounts of other people's capital. They're not risking their own personal savings on every position. Instead, they're using investor capital responsibly and earning fees from that management. This model allows them to scale. More capital equals larger positions. Larger positions equals higher percentage returns, all while maintaining strict risk controls. They use leverage, yes, but intelligently and within structured guidelines. This controlled leverage is part of how they generate high daily returns without blowing up. 4. Risk management is non-negotiable. This is perhaps the most important part of the structure. Every trade, every strategy, every system is risk managed first. Before they even think about profits, hedge funds ask, what is the maximum acceptable loss here? How do we protect capital first? They use tools like stop-loss triggers, value-at-risk (VAR) models, diversification across strategies and instruments, daily drawdown limits. This protects them from emotional overreaction and from catastrophic loss. It's the exact opposite of the all-in mentality seen in retail spaces. The strategy stack. How they win in any market. Now that you understand how hedge funds are structured and how they think, Let's look at how they actually make money, regardless of market conditions. This is what I call the strategy stack. It's not just one trading strategy. It's a combination of approaches designed to perform across different environments. Diversified strategies, not just one edge. Retail traders often rely on one setup, a trend line, a divergence, a signal. Hedge funds build multi-layered systems. They might run a long-term macro strategy, a short-term quant model, a volatility arbitrage system, a pair trading algorithm, and a market-neutral hedge. By diversifying across strategies, they reduce dependence on any single outcome. If one system underperforms, another can balance it out. Number 2. Profit from direction and from imbalance. Unlike retail traders who usually need price to go up or down, hedge funds profit in more creative ways. For example, arbitrage, exploiting small inefficiencies between markets. Market making, earning from the spread by providing liquidity. Options strategies, making money from volatility, not just direction. Event-driven trades, earnings, policy changes, macro events. This means they're not relying on the market going their way. They're trading edges, not predictions. Number 4. Data-driven refinement and automation. Hedge funds don't rely on gut feeling. They test their strategies using years of historical data, run simulations, and automate execution to remove emotional interference. They monitor win-loss ratios, risk-adjusted returns, performance in various market regimes, position-level metrics. They treat trading like a scientific experiment, with constant optimization. This keeps them relevant as market conditions evolve. Number 5. Daily monitoring and performance review. Hedge funds run daily and weekly reviews, not just of their trades, but of their process. They ask, did the system perform as expected? Were rules followed? What needs to be adjusted?
Let's zoom out for a second. Hedge funds aren't magical. They don't always win. But they win often enough with controlled risk using well-designed systems. That's how they can generate $1 million a day. And that's why this isn't just a story about rich people. It's a playbook you can learn from. Here's what the takeaway. Build process, not just strategies. Manage risk first. Diversify approaches. Stay consistent. Review and refine. This is how you turn trading from a stressful gamble into a long-term, income-producing system, no matter where you're starting from. If you can adopt even a small part of this mindset and structure, you'll be ahead of 90% of retail traders. And who knows, one day you might not just learn from hedge funds. You might build something that rivals one.